This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
Let's say you're able to get a fixed rate loan, and now your funding costs, your loan costs are, your debt service is fixed. Well, if there's inflation, wage inflation, and people have more money, rents are most likely going to go up in tandem with that inflation. And so now the top line revenue is going up on the property, but the debt service is staying consistent. Yeah. And that's where all of a sudden you can really expand that profitability, which is fantastic.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. If you're new to the real estate game or ever wondered how to kick off or expand into real estate investing, we have a very inspiring guest for you today. Our next guest is a man with great skill, especially with regard to building relationships and setting expectations, particularly with people in the real estate world, where the whole concept of know, like, and trust is a staple when it comes to the investor community. Now, he's an LP with close to 4,000 doors, as well as having positions as a GP and a KP, all in just 3 years. In addition, he has a podcast of his own, the Darin Batchelder Show. With all, I'd like to welcome Darin Batchelder. Thanks for coming on, buddy.
Augustino, appreciate you having me on the show.
You bet. Now, very excited about this too. Now, guys, if you like what Darin has to say, you can reach him via his contact page at darinbatchelder.com. Okay, Darin, go ahead and tell listeners a little bit more about your journey so they can get to know you a little bit.
Fantastic. So once again, thank you for having me on the show. Very much an honor. You are doing fantastic things in the real estate world. So appreciate getting to spend some time with you and your listeners. So in terms of my background, I bounced around a bit in different careers before getting into real estate. I was a CPA with Pricewaterhouse. I did both domestic and international audit with Pepsi. And then I moved into sales, software sales. And then I worked for a large Dutch bank, ABN AMRO, selling large loan portfolios direct to other banks, focused both on residential and multifamily. Started my own company doing that in 2007, still have that company. And about 4 years ago, I was like, I love the multifamily space. And I've been trading loans for years and years, but I haven't really spent the time to build any wealth from actually buying real estate. So I went looking for a way to do that. And the last 4 years have been phenomenal. Just so many great people in the space that are willing to help you get in and help you scale. And I don't think there's an asset class that I've seen like it, where the wealth building opportunities are just immense.
Oh, yeah. I mean, listen, this is the only business where if you ask Bank of America for $1 million to buy their stock, they won't do it. But you ask them for $1 million to buy a piece of real estate, and they'll give you 80% of it.
It's crazy.
Funny, isn't it? Yeah, it's crazy. It's crazy.
The other thing is stock. Talk about stocks. Most people, and I was in that camp, we're just taught. You get a job, you put money into a 401k, you pick whatever, whether it be ETFs or stocks or mutual funds, and just let your nest egg grow. But basically, you're just giving other people your money to manage. And you don't have the leverage that you have in real estate. So, if you buy $50,000 worth of Amazon stock, to get 100% return, that has to go up to 100,000. It has to double in price. Where with real estate, because you're getting a loan from 70 to 80%, the equity owners, that are putting 20 to 30% down, they don't have to have the property double in value to double their money, which is crazy.
That's right. And not to mention too, they also get to enjoy all the tax benefits that come along with it, right? Because they're owners, whether there's an LP, GP, doesn't matter. You're still getting all the tax benefits. I think it's actually better for an LP, honestly, for a limited partner, because they get all the upside and very little of the risk, in terms of dealing with the operational side of things, right? But again, I guess in your case, and we talked about this in the green room, you've set up a lot of your LP investments with good, trusted advisors that know what they're doing, right? And that's a big part of it too.
Yeah, so some people. I was on a call with a new potential investor yesterday, and she was asking me, how do you go about? She was saying, like, well, she's an accountant. I was an accountant a long time ago. Do you have this long checklist that you go through? And I'm like, I don't. The first step for me is I want to work with good people. So I want to pick the people first, and then secondly, the market. So I want to be in a state where I think there's growth, population growth, income growth, landlord friendly. And then look at the deal. What's the business plan? So if the business plan is to push rents to a certain level, then I want to look at surrounding apartment communities and see if, there's already a proven case for that.
Yeah. And I think that's the formula, right? That's the basic formula. I think part of it too is that person organizing the deal, a sponsor, is also, like you said, has to be a very trusted individual that knows what they're doing in that market. Because I think there's a lot of this thing that's going on these days, is that a sponsor is not from that market, and they're just buying 100 units in the middle of nowhere because they think it seems like a good deal, because their anchoring bias has them might be causing a problem in their ability to make a judgment on that deal. I'm sure you've seen that before.
Yeah, I've seen it. And I don't know where I play out on that. Obviously, I think there's less risk if you have a sponsor that has a lot of experience in that submarket. But if you think back to that sponsor when they first did their first deal, right? They had to raise money from somebody, and if that deal went well, and that helped propel them to additional deals. Well, when they go to break into a new market, you can't help but have the first deal in that new market, So, but they have all those years of experience of purchasing and running deals in the other markets. So I don't know where I come out on that. Obviously, I think there's less risk if you have a sponsor that like, and trust and has experience in that market. If you're working with a sponsor that, like, and trust, but they're going into a new market and it's their first deal, then, maybe you have additional eyes on it and more questions, but they might do all right. It's, I don't know where I come out on that. I would rather go into a new market with somebody that I trusted than going with somebody that I didn't know very well. Yes.
Well, that makes sense. So aside from that, what else do you look for in a general partner when you're partnering up with them?
It's definitely the know, like, and trust. I'm going to talk not so much about the partner, but because of my experience trading loan portfolios, during the Great Recession, where I saw people get hurt was with maturity risk. So, on these deals, you can't get a 30-year fixed rate loan. So there's all kinds of different options, but every loan option comes with a balloon feature. And so where I saw people get hurt was all of a sudden the economy tanks, cash flow goes down, cap rates go up, valuations go down, and the bank says, all of a sudden now you're on the end of you're coming up on a balloon where you either have to refinance or sell the property. And the bank says, well, property is worth $2 million less. You got to come to the table with $2 million of equity, or we're not going to refinance the loan. And everybody's holding on to their money. And so now all of a sudden property gets taken by the lender. To me, because I saw that happen, it wasn't when I was owning real estate, but when I was talking with a lot of portfolio lenders for banks, when I see that happen, it just forms a judgment for me that I prefer to have either longer term fixed rate financing, or in today's market, a lot of people are doing floaters, and I'm okay with doing the floaters as long as there's a long term on it. So if you get a 5 or 7 or 10 year term, but it floats, all right, well, as long as you could pay the mortgage, banks can't take the property from you. But if you have a balloon, like a lot of bridge loans are, 2-year fix or 3-year fix and then 1-year extensions. And look, I don't knock people that are doing bridge loans because they're very attractive. As long as the market stays good, they're going to be fine. But if all of a sudden the market goes sideways or goes the other way, those bridge lenders, they tell you that those extensions are like, oh yeah, those extensions, they happen, no problem. But when the market goes the other way, that person might not even be with the bank anymore, be with the lender anymore. And now all of a sudden they're like, I'm not going to extend it, and now they become a lend to own lender. Right.
That's right. No, it's interesting. In those portfolio deals, what would you say, if you even have it for privy to this information, what would you say was some of the riskier things that you saw? So I know you just mentioned here a second ago that they're getting into these shorter terms and maybe not anticipating things going sideways. Would you say that was a very common theme in those portfolio deals, or was it something else? Like what
so I wouldn't say it was like the big common theme. I just look at like where did people get hurt? Where did people lose their property? Because I think that multifamily is an amazing asset class for capital preservation and building wealth. But, if you put your money into a multifamily property, and real estate, is cyclical like everything else, right? So it's going to have downturns at some point. And when it goes into a downturn, you just want to know that you could ride out that downturn until it goes back up. Like I'm completely confident that it's cyclical and real estate values will go back up. You just don't want to be forced to sell in a bad market.
That's right. I mean, and right now the market's super hot. We all know that. And I think just about every market is across the United States is on fire. Hell, even other markets too outside of the United States are on fire too. I know that in my hometown in Windsor, Ontario, Canada, houses that were like super old houses built in the late 1800s, like we're talking little houses here, are now trading for $200,000. Ridiculousness, right? These are houses that when I was growing up would have been no more than $50,000 or $60,000. Yeah, right. That's 200 plus, right? It's just insane what's happening these days.
Single family, multifamily, every place. But because of that could end up helping multifamily.
Yeah,
afford to get into a single family home. So, maybe they end up. Having to rent longer than they thought they were going to because they can't afford to get into a starter home.
Yeah, that's right. I mean, and we talked a little bit about this in the green room. The way that we find deals is we use extensive broker relationships. We don't typically compete for the types of assets that we're buying on the open market. We understand that the reason why they're putting it out there in the market is because they want someone to overpay for it in today's market. That's the reason why. And it goes into their pricing, I can see that. And, but buying it right up front is the key here. But I think you're absolutely right though. What's happening is that with all this cap rate compression that's taking place, we're becoming a renter nation, if not we already are really. And housing is, especially in the rental housing market, is going to continue to grow. It's going to continue to grow. It has to, especially the way that inflation is kicking in these days. It's just, I think it's going to be a very interesting 4 or 5 years that are coming up here. It's very
Absolutely.
interesting.
So two things on what you said. One, like, look, you're in a position because you've performed, because you've done deals, because you've done what you said you're going to do with brokers and with investors. You've gotten to the place that you can do that, and where brokers will come to you first. Mm-hmm. That's a fantastic place to be, right? I had one very, very seasoned investor tell me, I want to be the first call and the last call. So the first call on an off-market deal and the last call on a marketed deal. So that, hey, if you do this, you got the deal type of thing. But it takes time to get there. So there's other people that are listening to your show that they're like, well, having to, buy a marketed deal and, and push the boundaries a bit. But look, 3 years ago, when I got in 3.5 years ago, I remember there were people that were telling me, hey, Darin, I was buying deals at 30, 40 a door and I'm out. I'm on the sidelines. And I'm like, well, I don't have a crystal ball, but I'm in. And, I bought at 80 a door, right? And that property is worth a lot more than that now. So there's no crystal ball. But I would say that you're in a good spot. Some other people may have to, to work on a marketed deal, and that's fine as long as you do your homework. And you might just have to look at more deals to find one that really gives you the warm and fuzzies.
That's right. I mean, in those cases though, where it's like, oh yeah, I was buying it for 30 a door, now it's way too much, yada yada yada. I mean, the thing is though, is that yes, we were doing the same thing in this market. However, now the cost of getting into a deal is a little bit less too. The financing is still pretty favorable. It's not the same as it was 4 years ago, 3 years ago.
Financing has come down dramatically. And hey, you brought up inflation. Here's the big question mark. So, real estate is supposed to be a fantastic inflation hedge. Mm-hmm. And if your funding costs, your loan, even if it's floating, it's going to be less than your rent. But let's say you're able to get a fixed rate loan, and now your funding costs, your loan costs your debt service is fixed. Well, if there's inflation, wage inflation, and people have more money, rents are most likely going to go up in tandem with that inflation. And so now the top line revenue is going up on the property, but the debt service is staying consistent. Yeah. And that's where all of a sudden you can really expand that profitability, which is fantastic.
Yeah, that's right. That's right. And that's another reason why, same with some of the assets that we're getting into right now, it's like there's a lot of upside on these deals. It's already under market today. There's one that I'm thinking about specifically. It's a pretty big deal. And not only is it below market today, by the time we close, rents will be even higher than what they are now because of all this inflation. It's going to be insane. It's going to be crazy.
That's a good thing. Now the piece that is a big unknown is, okay, so say you get that additional profitability over time. Well, that's going to increase the value. Mm-hmm. But if interest rates go up, even if your funding costs are consistent, then the exit cap rates most likely will go up. So it's a matter of, will your profitability increase more to the valuation than the downside of having higher cap rates 3 or 4 or 5 years from now? Nobody has that crystal ball, but that is part of the risk.
Yeah. Yeah. And I think part of it is really understanding your market. It's for the time being, our team is hyper focused on the Cleveland market. So we know where the deals are. We know who the brokers that we need to deal with. We know who they are. And we have a feel for the direction as to where the industry is, What are the top industries? What are they doing? Where are they moving to? These sorts of things. The next big market is Florida. Hey, have you heard Florida's a hot market, Darin? Have you heard about that?
Yes.
You might have caught an article somewhere about it. But again, in that case, though, I used to live down in that market.
Where
in Sarasota.
Where in Florida? In Sarasota.
Sarasota. Yeah.
I was on the East Coast.
Yeah.
I was Fort Lauderdale and Parkland.
Yeah, I lived out there too for some time. Yeah, I mean, right now that place is completely wild. I meing, it's nuts what's going on out there. I was out there for a seminar a few months ago, and it was like being in a warm version of New York City. Bumper to bumper traffic everywhere.
Yeah. Just
madness. I think the West Coast is still fairly calm, and the growth that they're experiencing is still taking place. So, but I know that market. I go to places that I know, right? And I get to build the relationships that, or continue to build the relationships that are built out years ago. I go back there and just, nourish them again, recultivate them and bring them back again. So it's, I think that's one of the things that again, I'm familiar with. I used to live there. It isn't like I'm going into, to me, it's not a new market. To me, it's right. I used to live there. So it's not a big deal for me. Now speaking of relationship building, I know that you're really big on relationship building, right? And leveraging the power of social media. What sort of tips and tricks do you use in those cases when it comes to building relationships and using social to strengthen those relationships?
So two things. I mean, relationships and social media. I'll kind of talk about those separately. Relationships. There's so many different relationships in this business, right? There's broker relationships, there's lending relationships, there's partnerships, there's investors, there's property management companies. From my other businesses and other experience, I kind of just leveraged what I did in those markets. And when I was, when I'm trading, $50 million or $100 million loan portfolio, the buying bank wants to understand, especially if it's the first time they're buying these types of loans from this other seller, they're relying on me to set expectations. Mm-hmm. So, hey, here's the good and here's the bad. And I do that same thing when I talk to investors about any deal that I'm raising capital for. Like, I have yet to find a deal that maybe you find these deals, but I've yet to find a deal that I love everything about the deal, right? There's some things that I'm like, hey, I don't love the location. And real estate, I was in a deal like this, and I'm like, real estate is all about location and I don't like the location. So if you're focused on location, then don't do this deal. But here's why I like the deal. And this is what, I like the owner. I like the buyer. I like, I like the tenant base. I like where the market is going. But look, I think that some people, I get deals come through my desk all the time. And most people that I see, they just talk about all the good. Yeah. And I think that when you talk about my experience, both in the loan trading space and in the multifamily space, investor space, is that, when you tell people, hey, here's what I don't like, then I think it gives them a little bit of comfort. Like, all right, this guy is telling me not only all the rosy, thing about this deal, but also where he sees risk. And am I comfortable with that risk also, or do I want to pass on this deal because of that? And so that's important to me. I want people to talk to me that way. And so I talk to other people that way as well.
Yeah. I mean, every deal has some sort of downside, some sort of risk, there's the key is quantifying it. And I mean, I guess I don't get into risky deals, like heavy risky deals. Like, I mean, there's one deal that recently traded here in town. It was a pretty sizable deal, like 300 units or something like that. It was built on a garbage dump, right? That's a risky deal, you see.
Right.
But and the funny thing is that was not disclosed on any of the documentation that was given to me by the broker. The only reason why I knew it was built on a garbage dump is because a friend of mine, I told a friend that we were considering making a run for that deal. And that friend connected me with the previous owner. We had lunch and he told me all about it. And he said, "Oh yeah, that property is built on a garbage dump." And
well, that right away, now you have a lack of trust with that broker.
Oh, for sure.
If that broker had called you up and said, "Hey, look, I got a deal. The bad thing is it's built on a dump, but here's why I'm still calling you." Now that, you still may have passed on the deal, but you would have had more trust with that broker. When people try to slide something past you, that's when you lose trust.
Yeah, that's right. That's right. And that's the thing. I mean, there's so many of these deals out there, and which is why, it's funny. We were talking about brokers too earlier. The brokers that I deal with are trusted advisors. They're I don't just consider them brokers. I mean, they are brokers, of course, but they're also friends. These people are my friends. Like I would invite them out for dinner, lunch, birthday parties, whatever the case may be. They're friends, and and they only slide deals my way that they know are good deals. They would never. They know they're going to collect a big chunk of change from that deal, but they also know that this is a solid deal, right?
Yeah, and look, the ones that do that, try to slide something by you, they're one and done. So these brokers that you work with, they understand the power of a relationship. The power of a relationship is that it's one deal turns into 2, turns into 3, turns into 4 and 5. And it's a long-term relationship, and it benefits both parties, So when you get into that type of relationship, both sides want to nurture that.
Yeah, that's right. Because if you get into if someone would have got into that deal, and again, it was not disclosed on any documentation whatsoever. I'm sure once you do a phase one, or that whoever did a phase one on that deal, a dump deal, I'm sure something will come up. And then they do a phase 2, they realize what's going on. I don't know if the deal actually traded. It should have traded by now, but we'll see. But I guess the point is that, those one and done type of guys, they don't typically last, or they get a bad reputation, and I don't even deal with those guys anyway. As a matter of course, I don't deal with them. They know who I am, but I don't deal with them.
Right. Well, that's smart.
This is the reason why.
Exactly.
Yeah. So good stuff. Well, we covered a lot of stuff today. Now, if someone's listening right now, okay, and they wanted a piece of bulletproof advice from you, what would you tell them?
And I tell people over and over again that look, you got to get educated. Read books, listen to podcasts, talk to people, go to seminars, but the biggest thing, the difference between the people that are successful and not you've got to take action. Yeah. So, and almost everybody that I've interviewed on my podcast or talked to on conferences, they were scared too. So you have to find a way, I say, to push past the fear and actually take action.
That's right. You can always come up with an excuse not to do something. And the key is just like you said, press through it. I remember on one of my first deals, I actually used my own money to do my very first deal, right? Because I just felt that I wanted to do my deal on my own. Sure. And you know what? It was a great deal. Made a lot of money from it. It was a small deal, but I got it at a very good price. So. But it helps instill that confidence to say that, look, I'm the real deal. I'm doing this, and I'm using my own money. It's a good case study for investors too. So
absolutely,
yeah. Awesome. All right, guys. Well, if you want to reach out to Darin, you can reach him via his website at darinbatchelder.com. Hope you got a lot of good insight, and hope you got inspired that anybody can get into this game. Anybody can scale their business. It just takes getting past the fear, taking action, and just doing what needs to get done. And of course, listen, if you're not even sure what to do, there's guys like me, guys like Darin that are out there, and we're always happy to help you out. So if you need anything, reach out to us. All right. So stay tuned, and I'll see you in the next one. Take care.
Augustino, thank you, my friend.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.